Hello everyone, welcome to JAIIB CAIIB English Medium channel by Adda 24/7. My name is CA Aarti and I hope you all are doing good. So first of all, please confirm me about audio and video quality before we start this session, and please join the session very fast. Okay, so everything is okay, then let's start this session. And remember, in this session, we are going to start and cover our Module C quick revision. So it's a request, whenever you watch this session during live or even if you are watching in recording format, try to give your answers. First try to select your answer, then listen to my answer, so that you can cross check whether you understood the concepts or you know the concepts, because if you know the concept, it will give you confidence. But if you are not aware of the concept or you are confused between the concepts, like in options, at least you can study after this session. Okay, so let's start this session with the very first question from module C. Okay, so here Sunrise Pharma Limited has a market capitalization 5,000 crore. Now the company has total debt of 1,200 crores, short term that is 200 and long term 1,000 crores, and cash and cash equivalents that is 600 crores. Now the CFO is preparing a valuation report and needs the enterprise valuation. Now what is the enterprise valuation of Sunrise Pharma Limited? Now you have four options and you need to select which is the right answer here. This one is your numerical question. So please everyone, it's a request to please try to solve it. This one is from first unit of module C, that is corporate valuation. Now, what is the meaning of enterprise valuation? Enterprise valuation means total value of your company. When we talk about enterprise valuation, here we will be adding all your equities valuation. Okay, let me write over here. First, we will be adding here equity valuation plus debt valuation minus, if you have any cash and cash equivalent value, just subtract from it. Yes, so we require three different factors for calculation of enterprise value. Enterprise value means what is the total value of your company. That is what. If you're saying market capitalization is only your total value, then you are wrong, because market capitalization here talks about your equity part. This is about your equity part. How we get this market capitalization? We get this market capitalization with market per share value of your companies into total number of equity shares. And this is the formula to calculate total equity value. So this is market capitalization. So we will be taking this market capitalization for the equity, that is 5,000 plus debt. Here, remember, debt is equal to 1,200 crores. Yes, what is the debt value here? Directly it is given, that is 1,200 crores. Whether it is short term, long term, you are not going to classify it. Debt means debt, borrowing means borrowing. Okay, so you will be adding here borrowing minus cash and cash equivalents, your bank balance, cash, any marketable securities whose life is up to 3 months, that is what classified under cash and cash equivalents. Now clearly they have given here, that is 600, so minus 600. So please solve this and that will be your enterprise valuation answer. So this is going to be 6,200 and 6,200 minus 600. That is going to be your answer. 5,600. Yes, so right answer is going to be answer A. That is your 5,600 crores. Please check this answer. Correct. Yes. So this is about your first question. Okay. Coming to next one now. A bank manager is reviewing the valuation of a manufacturing company, and the company's balance sheet shows total assets 800 crores. Okay. Total liabilities 320 crores. Now the current market price of share is 150 per share. Book value per share is 95. Now the value recorded in a company's books of accounts after deducting depreciation from the historical cost is called as what? Yes. See, in your CIB, you have different exam patterns. MCQ pattern, numerical pattern, without option question like you have here. Then you have match the following, case studies. These are some different patterns which are asked in your CIB level. So you need to prepare according to it. Huh? So please everyone tell me what is the right answer here. Yes. Now, as per this question, what they are giving you the data? When bank manager is there, okay, now they want to value your company. Now, the company's balance sheet is showing some assets, liabilities. Okay, so you have balance sheet values. Apart from that, they're giving you also current market price share. Yes, and book value per share also they are writing here. But the point is, what is the question? What question they're asking? The value recorded in a company's books of accounts after deducting depreciation. That is what means you need to tell me here in your books, whatever value you are recording, that is known as what? That is known as your cost value, your, you know, we have different values also. That is your book value, that is your market value. Okay, let me give you the hints. Whatever value you can see in your books, that is what? Book value or market value? Yes, tell me. Now I hope you can get the answer. Whenever you are checking your books and you are using all your assets, liabilities from your balance sheet, that is your book value. So right answer of this question is that is book value. Market value means in market, what is the price you are trading? Yes, that is what market value. That is the reason here, though you can say we have data of our market price also, but in question they're asking you what is the book's value in your, after deducting depreciation from the historical cost. So right answer here is answer book value. Very good. Yes, that is answer A. Okay, so remember this is your without option question. In without option question, they can ask you about theoretical questions as well as numerical questions. Yes, chaliye. Coming to next question now. Okay. So Rajesh is a credit analyst at a bank. Now he's valuing a steel company that has a large amount of physical assets, including land, plant, machinery. Now the company does not pay regular dividends and has volatile earnings. Now the analyst wants to use the method that best captures the tangible assets base. Now which valuation approach should Rajesh prefer in this situation? Income approach using DCF, market approach using comparables, cost approach, asset based approach, or dividend based discounting model? Good evening, everyone. Please tell me, out of these four options, as per the given statement, which is the perfect, you can say, approach for valuation? Yes, everyone, tell me. Please try to select any one answer, Hana. Yes. Okay, so you all are saying go with answer C. Okay, so let's discuss one by one. Okay, when we talk about income approach, yes, that is your first approach. So basically, how we are valuing here, we are valuing our assets based on, present or current value of the company's expected future earning. Yes, that is what DCF also. First, you calculate your estimated future earnings and then you do the discounting part. Yes, so what is the problem? Why we cannot use it? Because they are saying there is no regular dividends and companies earning is also volatile in nature, fluctuating in nature, so estimation is quite difficult here. So that is the reason we are not going to select this. market approach using comparables means based on your market, similar assets you will identify, similar companies you will identify, and you will value it. So that is what market approach, and here they are not saying they will be using market approach. Then last one is again dividend discount model. Whatever future dividends you are earning, you will take the discounting value with the help of constant dividend model, or you have zero growth model, two-stage model. These are different methods which you can use here. So that is also not given here as per the given answer. Right answer is yes, cost approach and asset-based approach, because they are saying you are going to value a steel company in which you have large amount of physical assets. So with the help of physical assets, you will try to value your company, and that is the best description of this particular situation. Yes, correct answer is answer C. Very good, everyone. Yes. Okay. Coming to next question now. Okay, now you haven't matched the following. You have column A approaches and column B the descriptions. Take your time and please tell me which are the correct options here. Column A, first approach is market one, then next is income one, third cost, and fourth is DCF. Column B is about descriptions. That is P uses present value of expected future earnings. Then Q compares with price of similar assets sold recently, or R values company based on its net assets value, or S specific type of income approach using discounted cash flows. Yes. This is without option question. Again, you have to try to give your answers, like our market approach description is in which option. Yes, income approach is in which option. Cost approach, correct option, and DCF approach, correct option. Yes, please everyone. See, it's a request, if you are not able to watch this session live, then please like this session, so that afterwards when you are going for a revision, at least you can review this for module C. Hana, this is a quick revision of module C. So it will help you in your future revision part. Okay. So you are saying R is P and Q. Okay. So it's like 1, 2, 3, 4 and R is PQ. Okay. I got one answer. And others, you can also share your answers. What do you think? Achha, market approach means what? Market approach means you will identify the most comparable asset here. Yes? Market approach means here you will identify the most comparable assets, or compares with the price of similar assets sold recently. That is what market approach talks about. So first, that is Q. Then next, income approach. Income approach talks about uses present value of expected future earning. That is what your, achha, we have one more option, a specific type of income approach using discounted cash flows. So here for the second, that is for the income, we have option 1 only, that is P. Income approach, second, that is P. In an income approach, we are going to use the present value of expected future earnings. Yes. And then next, cost approach. Cost approach talks about the values company based on its net assets value. So third, that is your R, and fourth, that is your S. So this is your correct classification. DCF method, specific type of income approach using discounted cash flows. That is what. So yes, DCF method is one specific time of approach where you have some specific methods on. Yes, that is your dividend discount model, constant growth model, 2-stage, 3-stage, H model. All these are some specific type of income approaches which you can use for the calculation of discounted cash flows. So right answer is 1Q, 2P, RS, and 3R and 4S. So this is your correct classification. Okay. You can also cross-check from here. Okay. Next question. Now, She Showed Limited has 15 lakh outstanding equity shares. Now, each share is priced at 50 in the market. Now, the company also has outstanding debt of 15 crores. Now, whose market valuation is 14.80 crores. Using the stock and debt approach, calculate the total value of She Sure Limited, one of the very easy method in your valuation chapter. Now, when we talk about stock and debt approach, you need to identify all your stock values, market values, plus just add all your debt values. That's it. And that will give you value of your company. One of the easiest method in your book, especially in your module C. Yes. Please tell me. Take your time and remember, in both the cases, you need to calculate their market value, Hana. In both the cases, you need to take what market value. If any book values are given, then you need to ignore it. Now, how to calculate market value? Market total value, market capitalization value that we need to take here. So, She Sure Limited has 15 lakhs outstanding equity shares. So, 15 lakhs shares. Okay, now each share is priced at 50 in the market. 15, अच्छा 50, ठीक है. So 15 lakh shares are listed on the stock market and each share price is 50 per share. If you multiply this, this will give you total market cap. And the company has outstanding debt of 15 crores, whose market valuation is 14.80 crores. So tell me, which value you will take for the debt value here? That is 15 or 14.80. As I already told you, for your calculation of stock and debt approach, you need to take market value. Okay, so outstanding, that is 15, but the market valuation is 14.80 crores. So just add this with the equity valuation. 15 into 50, 750 plus 14 point. Just a second. Okay, these are your 15 lakhs into 50. Okay, so it will give you 7.50 crores, 7.5 crores plus that is 14.8. That is equal to 22.30 crores. So total valuation as per stock and debt approach is 22.30 crores. This is the total valuation of She Sure Limited, one of the very easy method. Please recheck your calculation. Okay, please calculate very carefully. This is 15 lakhs and 50 per share. So if you multiply it, that is 15 lakhs into 50, that will give you 7.5. Okay, that is your 7 crores 50 lakhs and add with 14 crores 80 lakhs. So that is 22.3. Please recheck your calculation. Okay. This will come in crores, 7 crores will be there. Okay. Chaliye. Coming to next question now. Here's the calculation also. 15 lakhs into 50, that will give you 7.5 crores and the market value of debt is 14.8. Just add both the crores value, that will give you 22.30. Please make sure you are not making mistakes in this simple calculations. Yes. Okay, next. Zara Textiles is growing very rapidly at 20% per year for the next 3 years. Now, after that, the manager expects it to settle into a mature growth pattern of 5% forever. Now, the analyst must decide which DCF growth model to apply. Now, which growth model here they are going to select? Tell me, stable growth model or 3-stage growth model, 2-stage or 0 growth model? Yes. Here you need to identify which method Zara Textiles will select here. Very good. So now, as you can see here, they are talking about two different growths. First, when they have very rapid growth, yes, that is very rapid growth, that is 20%. And after 3 years, means for the first 3 years, they will see 20% growth, isn't it? And after that, management says that it will settle and they will be having now that normal growth that everyone is getting. So that growth is just going to be 5%. And this 5% is going to be for infinite time period. So as you can see, you have number one, 20% growth rate. Number two, that is 5% growth rate. So these are the two growth rates that here Zara Limited can value. Okay. So this is stable growth rate model. No. Next is 3-stage growth model. No. In this 3-stage growth model, you will be having one more stage where you can see, linear declining in the growth. So that is not given. So this is not a 3-stage. Zero growth model. No. In zero growth model, your dividend will remain same. Yes, suppose if company is giving in the first year, let's say 5%. So they will be giving 5% till infinite period. That is what zero growth model. But here you have two different growth rates. So that is not your D. So right answer is answer C. Yes, that is high growth then stable growth. Correct. That is answer C. Okay. Now coming to next question. Company A pays a constant dividend of 1.2 per share every year and does not expect to change this amount. Now, the required rate of return for investors is 7% and the bank officer wants to value this share for a client. Now, what is the value of their share under the zero growth model? Yes, you need to apply here zero growth model formula. Yes, please everyone try to solve it. Actually, let me tell you few points related to zero growth and constant growth model. Okay. Now, sometimes they can ask difference between sorry everyone constant growth model and next one is zero growth model. Okay, remaining models are like your 2-stage and 3-stage and H model. Now, under this constant growth model and zero growth model, there is a very thin line difference. So remember, in constant growth model, let's take example of your salary. Yes, let's say your first year salary is equal to 1 lakh. Yes, and bank says that every year they will give you 10% increment. They will give you what? They will give you 10% increment. Means here you will be getting first year 1 lakh. Okay, this is your 1 lakh here. 1 lakh. Then for the second year, you will be getting plus 10% increment. Means it is going to be 1 lakh 10,000. Okay, for the third year, again you will be adding 10%. Yes, so this is going to be 1 lakh 21,000. Yes, so as you can see, your 10% value is increasing. For the first year, this is your 10,000. For the second year, it is 11,000. Isn't it? Your value is increasing. Yes, your value is increasing. That is under constant growth model. You will see growth in your increments. You will see growth in your increments. But in zero growth model, they are saying that we will be giving you same percentage for the lifetime. Yes, we will be not increasing this valuation. We are not going to increase this valuation. We are going to give you constant growth. Okay. We are going to give you what? Constant growth without changing it. Means every year, same growth you are going to see. That is the thin line difference between these two methods. Now, if you know the constant growth model method, yes, that is, let's say here, let me erase this part now. Let's say under this constant growth model, your formula for the valuation is equal to D1 divided by R minus G. This is the formula. D1 means your next year dividend, which you are expecting based on your rate of return and growth. Yes, you will see a constant growth in the valuation. But with the same formula, if you apply here zero growth, means your D1 R minus G. But remember here, zero growth means your growth will always going to be zero. You don't see any growth in your zero growth model. Okay, zero growth, no growth, constant dividend, same dividend. That is what. If you are getting 5,000 in your year 1, till infinite period you will get only 5,000 in your valuation. That is constant. But here you have observed now, first year 10,000, 11,000, then 21,000, whatever it is, it will increase the valuation. That is the difference between these two. Okay. Now this question is asking about zero growth. Zero growth or perpetuity model is what? That is your infinite model with no growth. Yes, so just use the same formula. If you apply the same formula also, you can get the answer. So dividend, that is constant 1.20. There will be no growth, so G is going to be 0 here. Rate of return is equal to, that is 7%, so 0.07. Okay, with this formula also you can solve it. So that is 1.2 divided by 7. That is 17.14. So right answer is answer B. Okay, that is 17.14. Yes, and remember, what is the difference between zero growth and constant growth? Yes, because so many times they're asking theoretical question based on this, and so many of you are again confused that when to say no growth and when to say constant growth. Now I hope that point is clear. So right answer is answer B. Okay, next. Correct answer is answer B. Very good. Arun wants to buy a 2-acre piece of land. Now he's told the asking price is 10 lakhs. Now he has no idea whether this is a fair. His friend suggests he look at recent land deals in the same area for similar sized plots. Now this approach Arun's friend is suggesting is an example of which valuation method? DCF, cost relative, or book value? Again, very easy direct question we have. Yes, please everyone try to give this answer. Very easy one. Yes. Correct answer is yes. Answer C, that is relative valuation. Okay, yes. But when we talk about DCF approach, means you are going to estimate your future cash flows. Here you are going to estimate your future dividends and you will be discounting it. So just previous question when we discussed about zero growth or constant approaches, that is what covered under DCF approaches. Then cost approach means you will be using your balance sheet, assets value, liabilities value, that is. Book value approach is again similar with your cost approach only. Okay. So right answer is relative valuation. Means what? Suppose if I want to sell my land, okay, and here, let's say this land is equal to 5 acres. Okay. Now I don't know what value should I keep for this. So what I can do, I can identify, similar type of land. Yes, let's say this is my agricultural land. Okay, so I will search agricultural land near by that particular area. And let's say this land is 1 acre and recently they sold this 1 acre land for rupees 10 lakhs. Okay. So if this recent transaction means 1 acre for 10 lakhs, so 5 acres, how much I will be valuing this? If 1 acre is equal to 10 lakhs, then 5 acres are equal to be 5 into 10 per acre, that is 50 lakhs. This is simple maths we do, correct? So that is relative valuation, and generally we all use the same method. Yes, that is relative valuation. This is the same example you can see here. Okay, related to Mr. Arun. This is again one scenario based question. Okay, next. Now XYZ Bank has ROE 20%, required rate of return 12%, dividend payout ratio 40%, and growth rate 10%. Now a student needs to calculate the justified PB multiple using fundamentals. Yes, everyone. Remember, these fundamentals are very important from your exam point of view. Yes, and direct questions we have in your exam. Okay, so this is your direct PYQ question. Yes, it's a request to please attempt this question. We have different fundamentals given in your book, and those fundamentals are very important. We have PE multiple, we have PS multiple, we have PB multiple. Correct. So what is the formula of it? Okay, so here is your formula as well given. ROE, that is return on equity, into 1 minus B. B is your plug back ratio. What is now this B? See, let's say here my earning is equal to, let's say, 1,000. Okay, this is my company's earning. Now, what do you think? I'm going to distribute total 1,000 rupees to my investors? No. Otherwise, how I will expand my business? For the expansion, for the growth of my business, I need to keep some savings. Yes or no? Similarly, you are also doing the same thing. When you are earning your salary, are you doing expenditure for the full amount? No. You are saving some values also. Let's say if you're earning 50,000 per month. So here 20 to 30,000 you will use for your expenditures, and rest 20,000 you will save. Yes or no? Why you are saving? So that in future, if any uncertainties happens, or if you want any particular asset, you can use this particular 20,000 savings for your expansion, for your growth. Similarly, here companies are also doing. When they are earning 1,000 rupees or whatever amount, they will not distribute 100% dividend to their shareholders. So what they're doing, they are distributing some proportional value to their shareholders, and remaining value they are going to reinvest in their business. Okay, they are going to reinvest in their business. That is what here B means. This is your plug back. Correct. Let's say here dividend I'm distributing, that is 400 rupees, and I'm reinvesting, that is 600 rupees. So you know what equation it is? It says dividend plus your reinvestment amount, which is also plug back. Let me erase this R, otherwise you will think this is a multiplication. No? Okay, so this is your plug back equal to your total earning 1,000. 400 plus 600 gives you 1,000. Yes, this is how you can also calculate total earning. Now, what they are saying, you need to calculate here D. You need to calculate dividend. Can you calculate it? Of course. We know total earning is 1,000. We know our saving, that is reinvestment amount, is 600. So just remaining 400 is going to be your dividend. Simple? Yes. See, dividend you can calculate in this manner also, or if they are giving you plug back amount, you can subtract with the total dividend earning and just subtract it. But they are saying 1. So what they are doing, they are considering whatever value it is as 1. Okay. They are considering whatever earning you are going to see, that is equal to 1. So 1 minus plug back also gives you the dividend value. That is what they are using in bracket. Multiplied by ROE, return on equity. Now as an investor, whatever you have invested in the company, yes, let's say this is your financial year starting, and you have invested here 10 lakh rupees. Now after 12 months, after 1 year, let's say now you have earned here 1 lakh rupees. So what is the return you have earned? That is 1 lakh divided by 10 lakhs into 100. So 10% is your ROE. Means if you invest 10 lakhs in any company, in a 1 year, you are generating 10% interest. That is what ROE. Divided by R minus G. R is your return, rate of return, and G is your growth. Correct? Chaliye. So directly now we need to use this formula. that is 20%, so 0.20. And okay, this is a required rate of return, so 0.12 that is written. Now see, this is your dividend payout ratio. Okay, and growth is equal to 0.10. Okay, so this is your denominator. Now tell me, in numerator, are you going to write this as 1 minus 0.40? Yes, what do you think? Are you going to write it as 1 minus 0.40? No, Hana, because already they have given you 0.40 value. Okay? If you are doing 1 minus 40, then you are going to calculate this B. Here in this question, they're not asking you about the B value. Yes, already when you are subtracting 1 minus 0.6, you are getting 0.4, and they're asking directly 0.4. I mean, they have given directly this 0.4 D value. So remember, this part is very tricky part. Hai na? Sometimes we get confused that which is the amount we need to use here. If they're giving you 1 minus B, means if plug back amount is given, then do 1 minus B. If they're giving you directly dividend payout ratio, then directly use here, that is 0.04. 0.40, I'm sorry. Okay, chalo. Now please solve this and tell me what is your PB ratio here. This is your without option question. 0.2 into 0.4, that is 0.08 divided by 0.12 minus 0. That is 4. And this is your answer. So it's all about how much you know the concepts. If your concepts are clear, these questions are very easy. Okay, so it's 4 times. Means when you are comparing your company's market price with the book value, that is 4 times of it. Okay, that is what given here. Chali. Now coming to next question. Again, we have a match the following. Now this is your column A and this is your column B. Here you have multiples, that is P ratio, PB ratio and PS ratio. Now column B talks about companion variables like NPM, growth rate and return on equity. You need to identify correct companions here. Again, it's a request, if you are not able to watch this session live, then please try to like the session and try to watch it whenever you have the free time. Okay, but these are very important sessions. Yesterday we completed our module B revision. Previous to that we completed our module A revision. Yes, and today we are doing one quick revision of module C. So it's a request that please try to watch all of this quick revision series, and tomorrow also at same time 5:30 we are going to conduct module D revision. Okay, so please everyone. Okay, so QRP you are saying. Okay. Yes, so when we talk about PE ratio, so the companion value is your ROE. Okay, so 1 is R. Then I'm sorry. No, this is wrong. For the ROE, it is for the ROE, it is your Q. That is your growth rate. Huh? That is your growth rate. Yes, that is also known as PEG ratio. And your PB value is given through your ROE. And PS value is given through net profit margin. So 1 Q, second R, and third, that is P. QRP. Yes, that is the correct. Match the following. And you know, PEG ratio. Now, when we talk about P ratio, companion with the growth rate, we call it as your PEG ratio. This is your PEG ratio. Now, as per this PEG ratio, we can value our company whether it is undervalued or overvalued. If your answer is more than 1, means your company is overvalued. Okay. If you have PEG ratio less than 1, means it is undervalued. So these are the valuations you can use for the companies through the PEG ratio. Yes. And when we compare price to book value with the ROE, that is known as your value ratio. Yes. When you compare this second one with the ROE, that is known as value ratio. This is known as PEG ratio. And this was asked in your PYQ as well. Okay. So please remember this formula. It is very important from exam point of view. Chaliye, coming to next one. Now, Infosys has very few physical assets, but its brand, customer relationships, patents, workforce expertise make up most of its market value. Now, bank analysts trying to value Infosys using traditional methods to find the figures highly understated. Now, which category of intangible assets includes brand value, goodwill that arise from reputation and customers' trust? A. Identifiable intangible assets. B. Enigmatic intangibles. C. Collective intangible assets. Or D. Tangible fixed assets. Okay. Now this is again very easy question. And direct question. Yes, of course. Yes, everyone. See, first of all, when we talk about okay. So first, when we talk about intangible assets, okay, where it is given here, intangible assets means no physical existence. There is no physical existence. Huh? So clearly you can eliminate your option 4, that is tangible fixed assets. Tangible means you have physical existence, correct? Like you have a building. You can tell which is your building, land, build this machineries, equipments. Easily you can identify. These are your tangible fixed assets. So you can easily eliminate this part because we are talking about intangibles which are having no physical existence. Now, for the valuation of this intangible assets, we have 3 different approaches. First, that is identifiable intangible assets. Next is enigmatic intangibles, and third is collective intangibles. These are the 3 approaches you can use it. Now, identifiable intangible assets means you can clearly identify their cost. Suppose if I purchase patent, and if I register patent, I know what is the value of it. Correct. If I register copyright, I know what is the value of it. If I purchase trademark, I know what is the value of it. Clearly, I can identify their value. That is what identifiable intangible assets. You have registered that thing, you have paid some amount, you have given the brokerages, whatever it is. Clearly, you can value that amount. That is identifiable intangibles. Then, enigmatic intangibles means these are under WIP. These are currently under progress. But as soon as their search or research will be completed, that will give you benefits. For example, if I am a pharma company, right now I am doing one research. Okay. So during that research, I am not generating any value. I am not generating any profit from it. But one thing I am sure that as soon as I will complete this research, I will get the profits from it. So that is what enigmatic. Enigmatic means what? Right now, no profit, but in future, I am sure that when my research and development will be completed, I will generate income from it. That is enigmatic. Okay. Now, collective enigmatic means you cannot tell individually. Like right now, we say Apple company has a very good goodwill. They are having brand value. But what is the exact value? Can you tell that thing? No. We cannot identify their exact value. That goodwill, brand value generated over the period of time. And what is the actual value? See, if I say your nature is very good, so how much it is good? Up to 10, up to 20, up to 1,000, up to infinite. What is the exact valuation? Can you value it? No, because that is a qualitative thing. Similarly, here collective intangible means you cannot value it separately. Okay, it is you can say generated over a period of time. So that is collective intangibles. Now please read this question again, and if you want to change your answer, you are free to do it. Yes, what do you think? As per the given question, they are saying Infosys has a very few physical assets. Okay, understood, because that is one software company. Now, but its brand, customer relationships, patents, workforce expertise make up most of its market value. Now, bank analysts trying to value Infosys using traditional methods finds the figures highly understated. Now, what they're saying, which category of intangibles includes brand value and goodwill? Are you purchasing this directly? No. Can you identify what is the exact value that you have paid or registered for it? No. So here, a right answer is not identifiable. Enigmatic means that is under process right now. Already you are holding goodwill brand value. That is under WIP? No. So that is also not your right answer. Right answer is collective intangible assets. Right answer is answer C. Okay. I hope now you understood why right answer is answer C. Okay, coming to next one now. Again, we have one theory question. ONGC, an oil exploration company, merges with HPCL, a refining and petrol pump company. Now, these two companies operate at different stages at the same oil level value chain. Now, this merger helps ONGC control its supply chain more efficiently. Now, this type of merger is best described as what? Horizontal, where same industry, same stage, or conglomerate, unrelated industries, vertical, buyer-seller relationship in the same value chain, or reverse merger, unlisted acquiring listed company. Now, remember, in your PYQ, they asked questions from types of merger. Okay, types of merger is very important. And I think May 24 or in November 24, I'm not exactly 100% sure, but yes, there's one question based on types of merger case study. So it is very important now. Okay. So ONGC, an oil exploration company, merges with HPCL, a refining and petrol pumps. Now, see, and these two companies operate at different stages of the same oil value chain. Okay, the merger helps ONGC control its supply chain more effectively. Now, see, efficiently. See what is happening here. Here we have one crude oil company. Okay, this is a raw material generating company which is known as ONGC. Now, ONGC extracts the oil. Okay, and after processing, they are taking the help of HPCL. And HPCLs are having different petrol pumps. It is clearly given here. They are having petrol pumps through which they deliver all these oils to the customer. Yes. So this is which level of your type of a merger. Now, this is your raw material. This is your raw material supplier, and this is your retail supplier. So both are standing in different level of supply chain. Correct? They are not standing in the same position. They're standing at different levels. So right answer is vertical merger. Buyer-seller relationship. Here, ONGC becomes seller of this oil and HPCL becomes the buyer. Okay. And then when they're selling to the customer, they become the seller and customer becomes the buyer. So this is the relationship. This is the supply chain where you are merging supply chain entities. So right answer is vertical merger, buyer-seller relationship in the same value chain. But why correct answer is not horizontal merger? Let's say this is your HPCL ticket. Now we have one more company, that is Bharat Petroleum. If Bharat Petroleum and HPCL merges, then that is your horizontal merger. Why? Because they are competitors and they're standing at the same level. So that is what same industry, same stage, reduction of competitors, and that is horizontal merger. Yes, so right answer here is yes, that is answer C and not A. I hope this point is clear. Generally, we discuss here Vodafone Idea example because they both were competitors earlier before merger. Okay, so same level they are standing, and if they merge, that is horizontal. Vertical means in a supply chain you are merging. Okay, now next is your conglomerate. Conglomerate means unrelated companies, totally unrelated companies. Let's say, Reliance Geo started, let's say, hotels. Okay, so that is totally unrelated. Geo is related to telecommunication. Hotels are different industry. Two different segments. So if you merge, that is going to be conglomerate merger. And this is not the answer. Reverse merger means if any unlisted company. Generally, I say if Aarti Private Limited, that is a unlisted company. If Aarti Private Limited acquires, Reliance Industry, Reliance Limited, that is a listed company. That is reverse merger. So here we are not talking about these two things. So right answer is answer C. Next. A listed company receives a hostile bid from an aggressive acquirer. To protect itself, the target company's board decides to allow existing shareholders to purchase new shares at a heavily discounted price. Now, this dilutes the acquirer's stake significantly. Now, this anti-takeover defense strategy is called what? Poison put, green mail, poison pill, golden parachute. Yes. Again, I'm saying it's a request from my end that please watch this session. These are your quick revision, okay, based on your module wise of your ABFM. So please try to revise with these videos. If you're not having time to go for the conceptual classes, yes, then these are going to be very helpful for you. Okay, so let's quickly revise. These are the anti-takeover defense. Achha, what is the meaning of takeover? Let's see. Here is one company, that is Reliance company. Okay, and here is my company, that is Aarti Private Limited. Yes. Now, if my management is ready, that yes, let's merge with the Reliance company. Okay, if both the managements are ready, then that is a friendly takeover. That is a friendly takeover where Reliance will purchase my company's shares. Okay, that is a friendly one. But if let's say my management says no, 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 we are not ready for the merging with the Reliance. We are not ready for that. In that case, Reliance will opt, different ways to merge with this company or to take over this company. Correct? So what are the different ways? That is your purchasing from share market or by negotiation. These are some ways. But in that case, Aarti Private Limited can use some steps to avoid this takeover. And what are the steps? That is given under defense strategy. And a defense means to protect themselves from the hostile takeover. So let me tell you, we have few lists here. First is pre-offer. Means before someone try to do hostile takeover, use these strategies to get the protection. Okay, first is staggered board. You will make a group of board of directors, and every year they will change. Like in your bank also, you are changing your job. Na? That is the same thing here companies are also doing, so that no one can purchase or manipulate any board of directors. So that is staggered board. Now, super majority clause. Normally what we say, if you want to pass any resolution, you require general or specific. General resolution means 50% voting rights. Special means 75% voting rights. But if anyone wants to merge with your company, or if anyone wants to take your company, you need to take at least 80% shareholders approval. Yes, you require at least 80 means more than 80% approval from your shareholders. That is super majority. Poison pill. This allows existing shareholders to buy securities at a very low amount to dilute bidders' stake. Now, what you are doing, you are issuing shares at a very low amount so that existing shareholders can purchase more number of shares and increasing their number of shares by reducing Reliance share. That is poison put. Target issues redeemable bonds repayable early first time bid happens. So what you are doing, you know what? Here, let's say earlier your debt value is equal to, let's say, 5 crores. Okay? Equity is equal to 20 crores. This is current scenario. After knowing that someone is going to do hostile takeover, what you are doing? Now you are increasing your debt. Let's say debt is increased to up to 20 crores. Equity will remain same, that is 20 crores. Now you can say this company is having, you know, high amount of debt, and as debt increases, borrowing increases, that becomes less attractive. That is what poison put. Then dual class shares, we are issuing different classes of shares with voting rights, their features and everything. That is golden parachute. Here you are giving, you know, very attractive offers to your high officials, that if anyone does any hostile takeover, then we will be offering, not we, that company will be giving you special offers like, you know, luxurious car, luxurious bungalows and everything, so that if anyone tries to do hostile takeover, they need to provide some benefits to their top officers, which is very costly thing. So these are some points under your pre-offer ticket. Then after that we have here, that is post offer. Means what if someone already did this hostile takeover, then what are the options? First, green mail. What you are doing, target company buybacks its shares from the acquirer. Let's say you have purchased my company share hostile, but now what I'm saying, okay, you purchase my company shares for 10 lakh rupees. Now I will give you 20 lakh rupees and give my shares back. Okay, that is what, that is green mail. Pacman defense is a very interesting one. Listen, your target firm counters by trying to acquire the hostile bidder. You try to purchase my company shares. Okay, this is one transaction. On the other hand, what I am doing, I am purchasing your company shares now. You purchase, let's say, 25% of my company share. I purchase 45% of your companies. So you will get afraid, Are, what she is doing, what this company is doing, they are purchasing, so ultimately they will become owner of us. So this is also one way to reduce hostile takeover. Then litigation, file court case, very easy. Asset restructuring, identify the most, attractive thing of your company or strength of your company and try to sell that thing. Yes, so that rest of the assets and rest of the things will become unattractive. Then liability restructuring, here target buys back the shares or issues new shares to the friendly parties. So these are your post and pre-offer. Yes. Now as per this question, they are saying that during the hostile bid, aggressive acquirer, to protect itself, the target company board decides to allow existing shareholders to purchase new shares at a heavily discounted price. That is green mail, no golden parachute. That is poison put or poison pill. That is poison pill, where you are issuing shares at a discounted price. So right answer is answer C. Okay, chalo. So with this we complete our today's session, and I hope you have revised so many concepts, and remember now you have very less time for your CAIIB June 26. So if you didn't start your preparation, then last quick revision you can do along with us also. And for that you need to visit to Adda 24/7. First is our official website, all courses JAIIB, CAIIB. Your attempt is CAIIB 26. I'm saying this particular path for those candidates who didn't start their CAIIB preparation even after registration. So this is the last resort through which you can do one full revision of your important points as per your exam, and that is through our Power Pack revision batch. This one is your bilingual one. This one is your English one. You can start a preparation with this Power Pack revision batch for 1 week, means before your exam. We are going to conduct Power Pack revision batch with all your important points, all your important MCQs. Yes, so for enrollment, just click on buy now. Before paying 2182, use one coupon code, that is Y895. If you apply this, you will be getting huge offer and you need to pay only 1975 rupees. That is the discount offer for all our candidates who are preparing for CAIIB June 2026 exam. So all the best for your exam, and remember one thing, tomorrow we are going to do our last module D quick revision. So make sure you watch that session as well. And if you haven't subscribed to our channel, do it right now so that you won't miss all such revision series for upcoming attempt. All the best and bye-bye. Thank you for joining.